As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Monali Jain from Go India Advisors. Thank you, and over to Ms. Jain.
Thank you, Randy. Good morning. Welcome to the participants. We have Chief Financial Officer. We must remind you that a discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk.
Please wait. I'm unable to hear anything.
We'll hand it over to the management right now, so you can go ahead.
Yeah, we couldn't hear anything what Monali says. Anyway, thank you, Monali. Good morning, ladies and gentlemen. Am I audible?
Yes, sir, your voice is audible. You can go ahead.
Okay. Thank you for joining us today for the Q4 and FY24 earnings call. I hope you had the opportunity to review the earnings presentation available on both the stock exchanges and on our website. Before Venkat presents the financial results, I'd like to provide a brief overview of some important updates and key highlights for this quarter and the financial year. FY24 has been another successful year for Data Patterns. Over the past 3 decades, we have strategically advanced up the value chain by developing complete systems using reusable building blocks and leveraging on our existing competencies. This strategy has facilitated our expansion in a small way into new geographical markets, including Europe and East Asia, where we have successfully competed with foreign OEMs. Our sustained investment in products and technology has positioned us at the forefront in our field. Over the years, our strong R&D capabilities has enabled us to undertake significant product development. We successfully developed and delivered 9 precision approach radars to the Ministry of Defense for the Air Force and Indian Navy requirements, delivered command and elite systems as well as self-protection suites for land, mobile, and reconnaissance aircraft. Data Patterns has an order book of about 1,083 crores at the end of FY23-24, which has grown 13% year on year, and a CAGR of 30% between 2021 and 2024. Our diversified order book with significant contributions to radar at 64% and avionics at 21% highlights our strategic positioning. While Venkat will discuss the results in detail, I just want to touch upon the financial performance for the year. In FY24, our revenue from operations witnessed a 15% growth. EBITDA demonstrated a growth of 29% over FY23. EBITDA margins during the year stood at 43%. The broader context of our performance is shaped by the significant transformation underway in India's defense sector. The government's initiatives such as Atmanirbhar Bharat and Make in India, coupled with increased capital outlay, are driving this change. These developments provide an excellent platform for companies like us to capitalize on substantial domestic opportunities in the defense sector. Keeping this sectoral tailwinds in mind, we are committed to sustaining a revenue growth of 20-25%. As part of this product development initiatives, Data Patterns is developing complete systems in radar, electronic warfare systems, and communication systems in line with the in-house competencies meeting international standards. These products are expected to bring in revenue growth over the next 3 years post-trials. For FY24, the board has recommended dividend of rupees 6.5 per share at 3.25% and equity share of rupees 2 each, will be subject to approval in the ensuing AGM. We are committed to maximizing value to our shareholders. At this point, I will pass the floor to Venkat for his comments.
Thank you, sir. Good morning, ladies and gentlemen. We are happy to present our annual financial highlights for Q4 and financial year 23-24. Let us look at an overview of our financial results. For financial year 2024, our revenue from operations increased by 15% year-on-year, reaching 520 crore. We maintained a robust gross margin of 68%. Development contracts contributed to 42% of our revenue mix, with the production at 54% and service at 5%, showcasing growth across all three categories. EBITDA of 220 crore witnessed a notable year-on-year growth of 29%, with an EBITDA margin of 43%. Profit before tax stood at 242 crore, while profit after tax surged by 47% year-on-year to 182 crore. In quarter 4 of FY24, revenue was flat at 182 crore. We had a better quarter-on-quarter performance in financial year 23-24, with Q4 contributing to 35% of the yearly revenue, as against 41% in the last financial year. Profit before tax stood at 95 crore, while profit after tax witnessed a 28% growth, reaching to 71 crore. We continue to be a debt-free company. Our receivable days came down by 28 days, while inventory days increased by 32 days due to advanced procurement of materials for contracts deliverable in FY24, 25, and 25-26. As of March 31, 2024, we hold over 745 crore in cash and cash equivalents and liquid investments, underscoring our financial strength and liquidity. Overall, we delivered a strong performance in Q4 and financial year 24, and are confident of a steady growth momentum for the year ahead. We will endeavor to bring down the working capital days and sustain a margin of about 35 to 40%. With this, we will now proceed to Q&A session. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Jyoti Gupta with Nirmal Bang. Please go ahead.
Good morning, sir, and thank you. Congratulations for good set of numbers, something which I had anticipated. Two things that I would like to understand in terms of revenues. What is going to be the percentage in domestic and exports? Means what's going to be the contribution of exports coming from the revenue side? Ballpark within the next 2 years. What do you anticipate? Second is, do you expect your inventory days to go down from 187 in FY25? Third is, there's a steep decline in your raw material costs. Could you give some flavor on what are the key reasons for this decline in raw material costs?
Okay. Let me take this question, last one first. There is no steep decline in raw material costs. Our margins vary with the contracts we execute. The gross margin varies with contract to contract. We had a good set of contracts where there's a lot of IP of ours, so the margins are last financial year, the margins were better than the previous financial year. And most of the orders being single vendor, we had the margins available with us. So it's not necessarily the raw materials have gone up. That is why our margins have gone up. Second is on the export and domestic, the opportunity in India is very, very high. Okay, and we are trying to now go into Make in India solutions against traditionally importing, weapon systems and equipment, defense equipment from abroad. So this has opened up a lot of opportunities in India. The growth story has to be more in India today, and later you have to look at exports. Having said that, so the large part of the business is going to be Indian, and the growth is going to be here. We have order book of more than 70 crores from export orders which we won against contracts. Some are single vendors, some is open competition for products designed and developed in India. These are not offset contracts. This has been developed by us with local IP. So we expect that these will be exported in the course of this year. So if you look at, that is going to be there. The third question, you want to know whether working inventory days will go down.
Yes.
It all depends on the mix of contracts which we get. We had some large contracts which we have, bought inventory, and inventory gone up from last year to this year because we're holding inventory for execution for some of the contracts this year as well as next year. So inventory has gone up. So this is going to be more towards the kind of contracts we're expecting rather than a forecast for inventory days. This business has a larger inventory days. Inventory turnover ratio will be low in defense business because it's capital account business. Plus, there is a lot of acceptance criteria before the consignment gets shipped. So there is a lot of interaction with third-party agencies. So inventory days become slightly longer. But our interest is to reduce working capital days, net working capital days, which we're working towards. The next 2-3 years, you will see a substantial decrease in terms of net working capital days going ahead.
Okay. Thank you. And I'll come back in the queue. Go back in the queue, sir.
Next question comes on the line of Abhishek Sundar from Naredi Investments Private Limited. Please go ahead.
Hello. Good morning, sir. Am I audible?
A bit louder, please.
Yeah. Okay. So my question currently, what is our order pipeline today, and out of which how much is the L1 order and what is our success rate?
Essentially, we have about 1,000 odd crores order book on hand as of today. And out of which, I think about 360 to 400 crores have been in L1 business. I think I'm not very sure exactly line-wise. I don't have it in my mind. I know about 2 large contracts with L1 business, so I'm saying around 35 to 40% could be L1 business. The rest are all mostly single vendor business as a order on hand situation. On the order pipeline, which you talked about, we're looking at a pipeline of more than 2,000 crores. So, but those pipeline, when we predict to the market, is all based on previously delivered orders or single vendor contracts expected. We don't talk about pipeline with respect to competitive business because competition go either way, whether it's 0 or 1. We may also do the business. So I'm not predicting or forecasting. The numbers I give to you are based on only data products and single vendor or repeat business, production business, from whatever we've delivered earlier to the IDO.
So, sir, how much order will we get in FY25? Order inflow in FY25?
We expect another 1,000 crores order intake during the course of this financial year.
Okay. Thank you so much.
Thank you. Next question comes from the line of Dipen Vakil from Research Analyst. Please go ahead.
Thank you for the opportunity, sir, and congratulations on great margins. So, my first question is on the line of, sir, you won a significant order from Bharat Electronics in this quarter. So, can you give some more light as to for what platform of product that pertains to?
I'm not very sure whether this Bharat Electronics order will come this quarter or next quarter. We're expecting some contracts with BEL, but it still not happened. There's been a delay in that contract. Hopefully, we expect that in the next 2 quarters, we should get the order. But I think it's a bit preemptive now. We don't want to, if the contract is still not in our hand, I don't think it is appropriate to talk about the contract or the platform. Maybe once the contract is, we get the contract, maybe it's the right time to talk about it.
Apologies, sir, because I asked that question because it was already there in the major order received in 4Q. Hence. So my second question is on your R&D plan. So you plan to invest
Once again, there's one more order already received for last year, and I was thinking you're talking about this year. Last year we received order. This is for a program called Arudra, where it's a radar, 8 radars to be delivered by BEL, and we won some contracts as part of that order.
Okay. Thank you so much for that clarification. So, second question is on research and development expenditure and CapEx. So you foresee you will be incurring around 150 crores in next 2 years. So can you give us some guidance in terms of where we will be investing that and what are the new products and development that we are focusing on in next couple of years?
Okay. See, our CapEx spend is going to be two levels. One is in factory building and infrastructure, which is going to be spent in the next 2 years. Because expecting the larger contracts to happen, we have to create an infrastructure to deliver on those contracts. We've already bought land, nearly about 4.5 acres of land right next to us. So we expect to build some more factory infrastructure in the next 2 years, and also some test infrastructure for the ensuing contracts to deliver. So that infrastructure will happen. Maybe 100+ crores will be spent over the next 2 years on this. We are making estimates internally and getting more approvals before that is spent. The other things you talked about is product development. We have raised money last 23 March for product development during QIP. So that already we have started spending money on certain areas of operation. The main areas we have spent is going on into radars, into EW, electronic warfare suite, and communication equipment. The three areas where money is being presently spent. A lot of development has already happened. So the next 3 to 6 months time, some of the products will start coming out, and we'll start undertaking trials with the customer to see that acceptance is there. So this is the first area of investment we're making, and that will be around another 100 crores plus we'll be spending on these areas of development.
Got it. So just a small follow-up, sir. What would be our R&D expenditure as a percentage of revenue for this year, for FY24?
Maybe around, see, this is development expenses. We've taken a separate fund available from market for this. And so, but maybe if you look at 20%, maybe about 20% to 25% of our overall revenue, we will be doing actually product development this year.
Okay, got it.
The next 2 years like this.
Got it, sir. Thank you so much for answering my question.
Thank you. Next question comes from the line of Hardik Rawat with IIFL Securities. Please go ahead.
Hi, good morning. Thanks for the opportunity. Firstly, I wanted to understand what sort of, like you mentioned that you're looking at about 1,000 crores worth of inflows in FY25. Wanted to understand within this, the Arudra execution, what should be the value of that of inflow from the Arudra program, and what will be the execution timelines for the same?
So this Arudra, already we received the order as of last year, and that will be executed over the next 3 years as per schedule given by Bharat Electronics. But that is not part of the future expected orders this year.
All right. I had a couple of questions with regards to the balance sheet. So there's a sharp jump in the other current liabilities, which has led to a substantial improvement in your net working capital cycle. Can you please explain what this jump is? What is the reason behind this jump?
Yeah. Other current liabilities basically is because of advances received from against contracts from customers. Last year it was around 190 crore. It has gone up by almost 100 crore. That is reflected in the other current liabilities increase in the balance sheet. Advances from the customers for 2 contracts, actually we got additional advances. That is what is reflecting the increase.
Understood. And also, like you mentioned that you have an order pipeline of 2,000 crore rupees for FY25. Is that correct, right?
The pipeline is not just the 25 or 26. The pipeline, yes.
Also, 2,000 crores for FY25,
2,000 crores. 24, 25, we expect the new order intake around 1,000 crores.
Understood. And sir, just wanted to understand lastly your guidance in terms of revenue margins and net working capital cycle for FY25.
We expect to grow the business 20 to 25% in terms of revenue, and with EBITDA margin of around 40%, 35 to 40%, and bottom line growth of probably about 30%. And as far as the working capital days is concerned, can you give some numbers?
We expect, we are working towards reducing the working capital days. Actually, this year also, FY24, if you see, receivable days have come down by almost 30 days. But still the next cash conversion cycle is high because of the inventory. Inventory is expected to be high only, but we will, over the next couple of years, we will reduce the number of cash conversion cycle days to about 270 to 80 days. That will happen over a couple of years only. For 24, 25, it largely depends on the inventory days.
Got it, sir. I'll get back in the queue.
Yeah.
Thank you. Next question comes from the line of Parvati Rai with Equentis Wealth. Please go ahead.
Thank you for taking my question. So with respect to the outlook given on revenue, where while we mentioned that revenue growth of 20 to 25% for this year, and on a sustained basis, the slide also states a 25% plus CAGR over the next couple of years. So I want to understand, last quarter as well, we gave a revenue outlook of 20-25%, and prior to that was 25%, but came in at almost 15% YOY. So what exactly should we kind of look, even for going forward years, should we take it at 20-25%, or would it be 25+% CAGR that we are speaking of?
The last year also predicted about 20% growth, but we could not, our original plan, internal plan is about 540 plus. We achieved doing 520. This is because two products are ready to dispatch, but inspection is getting delayed from customer. So still the inspection is not, so one is finished, the other one is still to start. So we were actually close to guidance, but we could not do that because of the third-party interactions. The other product is ready. Second is, however, we are able to keep the bottom line growth because the particular contracts had better margins, so we could do this. And of course, this is also predicted by us in our budget to our board. Coming to your second question is, this is the reason why the prediction was slightly lower. Actually, we achieved lower than prediction, so the bottom line was in line with expectation. When you say 20-25%, I think we should be able to achieve this. Maybe even more than that, probably we can do, depending on how the delivery happens this year, because of the complex delivery, a lot of development is there. So that is why we are giving a range. In case we are able to, go through the process, it's not just the company which is involved here. The third-party inspections are there. The customer is development oriented, so there likely to be ups and downs in this on quarter and quarter. So that is why we're giving a range. But I think we will be able to achieve whatever we are telling you now. 20, 25, 25 plus, we should be able to do it.
Okay. And then the margins.
We have an order on hand, and some of the orders, expected orders also, started advanced work to see that we deliver on time with the customer expectations. So I think we should be very near guidance with everything.
Okay. And with respect to the margin outlook as well, so while this quarter saw a very good margin at 50% plus, so what I'm looking at, how sustained is that? While 40% is something that you have guided for overall in your PPT, while you gave your starting commentary, outlook was given at 35 to 40. So I'm just trying to understand where does that sustained margin lie? I mean, from the lumpiness that we saw during quarter 4 on the higher side of 50 plus, would that be repeated during the year sometime? And what brings in that? I mean, while you did mention that it was the IP and not more of the raw material which brought in that expansion. So could you just help explain that? Because while 35 to 40% is something that you put in your opening comments, the slide presentation does have a 40% plus sustained margin. So, I mean, should we expect the upside that we saw during this quarter again sometime during the year, or how frequently, given that IP is now being leveraged?
I don't know. I don't understand the question.
So basically on the operating margin, you did mention that then somebody did question that the raw material cost was one of the reasons for an improvement in margin. So you did mention that it was not exactly the raw material cost, but also the company's own IP that was used. So I just wanted more clarity around that, on how it helped improve margins, and going forward, I mean, should we expect more margin expansion as the company uses the IP products?
What really happens, if it's our product developed completely in-house and we sell it, typically the margins which we've been reflecting on our various years in the P&L, which you've seen in the last 3 years. What happens sometimes is a mix of contracts. It's not just our products. We also take some integration as part of the overall deliverable. In which case, then when you buy products and integrate, obviously it's not our margin, it's the integrated margin of the overall system. So margin tends to come down. So it's a question of the contracts we take, and depending on that, the margin varies. So coming back to the question of this year, what we do, why we're saying 35 to 40%, a range is basically because the kind of revenue, which projects will get executed in the course of the year. That may vary. That is why we're given a range. But if it is only our products, it will be around 40%. But when you increase, when you try to integrate systems, it comes lower. So cumulatively, it comes to 35 to 40%. So we are likely to do a better revenue, higher revenue, and if the range, then the margins are sometimes lesser. That's why I've given a range. But we closer to 40% is what we expect.
Okay. So one last question. Primarily with respect to the order inflows that you spoke, so you did kind of put in at around 1,000 crore for the full year of FY25. So quarter 3, we did mention about 5 to 6 billion over the next couple of quarters, of which we did say in Q4 around 300 crores. So I want to understand of the 1,000 crore order inflows that we are talking, would that be spread out across the year, or are we expecting in Q1 and Q2 of the basis that we spoke in the last quarter, major chunk of it, at least 50% all of that during the first half? I just want to understand how the inflow would be there during the first part of the year.
This will be spread through the year because the inquiries, some have come, some have to come. There may be delays in the inquiry and negotiations, and then order happens. So I can't give you a quarter estimate at the present moment. In our own thinking, our budget, we expect to not ship more than 10 to 15% of the incoming order book for this year execution. So it's all meant for next year and year after next execution. So the order inflow will happen over the year. I can't clearly specify exact quarter it will happen, though we have an indication, but it's not better to commit on that right now.
Okay. That's it from my side. I'll fall back into queue. Thank you.
Thank you. Next question comes from the line of Gagan Pareja with Ask Investment Managers. Please go ahead.
I hope I'm audible.
Yeah.
So the first question is around the guidance that you've given. In your top line guidance, you indicated of 20 to 25%, margins outer limit of 40%, which is lower than what you've done this year. And yet I think you indicated a profit guidance of 30%. So I'm just sort of trying to reconcile if the margins year on year are going to be, slightly lower than what they have been in 24, then why would, the profit guidance be 30% for a sales guidance of 20 to 25?
It depends on revenue growth, operating costs, and the overall margin, and also the kind of products which we ship this year. So that is why I'm giving you the approximate guidance numbers. I think we should retain guidance. We want to retain the guidance of try to somehow make the bottom line growth as important to our office, our operations. So the focus is there, and focus is on margins. So there are some contracts we've taken up which probably have lesser margins. The revenue growth may be higher than what we've suggested. We manage to ship those revenue, but our mind is on the bottom line growth. So that is why we are giving you this, and not giving a complete every segment correct representation. It's a mix of contracts, mix of deliverables. So I'm giving you a growth numbers accordingly.
So what you are suggesting is that either the top line can be more than what you are currently guiding.
Can be more. Can be more. We want to retain guidance on the bottom line, so can be more. So it depends on how the year proceeds. So that is why I'm giving you a critical number range.
Okay. And so you also somewhere in your PPT indicated that share of DRDO or the contracts will come down in revenue contribution, and that of MOD will keep going up. Is it possible to understand?
Did I make it in the PPT? I don't think so. I think I made it in the same DC interview this morning. Maybe you listen to it. Maybe you're one of the listeners. I don't know. See, what I was asking this question was brought in a very broad kind of perspective. There's a lot of dependency on DRDO contracts now. Even today, we do a lot of DRDO business. And there is a mother contract which you get. Yes, a repeat contract comes from Bharat Electronics or HAL or the PSUs. This is how the line of business has been going, except some few contracts like Precision Approach Radar, we directly got a contract bidding openly in MOD tenders. What we did tell the CNBC interview here is that going ahead, we will continue to engage with DRDO for our programs. And this is where we learned our business, we learned our competencies. We continue to engage with them and try to do more with DRDO. But having said that, if you want to scale this company to a few thousand crores, it has to necessarily come from market which is MOD driven. MOD driven market is very large. So we need to address that market. We have to get the growth which we are planning to, especially considering that the competencies the company has built over so many years, and also that we have taken money to do product development from the market, like actively developing products. So these have to finally go to MOD sales. So we are trying to engage MOD in a large level to see whether we can have products which the inquiries are coming in. Where most companies work with collaborations, we try to work with in-house IP. So that is where the development mode financing is coming into picture. Going ahead 3-5 years, I think scaling will happen with MOD business. That's what I said.
Right, sir. I'm just trying to understand, from a margin and working capital perspective, are the MOD orders going to be different, in their constitution compared to the DRDO orders?
It again depends on whether the MOD contract is purely designed, 100% designed developed by us, or it also involves vehicles and other subsystems, generator sets, UPS, antennas, building. If these were to come into picture, there will be integration costs also attached to it, and the kind of contract, the margins will vary. It is only our contracts with IP, then we compete with foreign vendors, so the margins tend to be higher. Again, it can't be clearly told here, contract, what are them, because we have to bid against very many companies and consortiums, and we have to get a lower score and be there. So there is a mix of both. I don't think it is a clear-cut answer. What is the important thing is, we want to scale the business multi-fold in the coming years, and we want to be profitable in the coming years going ahead. So we want to see that sustained bottom line growth is happening over the many years. This is the idea. Obviously, some contracts, the margin levels will come down because there is competition and we are integrating. So that we have to be very clear about. But these are all contribution margin pricing, which we need to do. As long as we're able to handle the overheads and ship the consignment, that's what we look at. The size of business is very, very large. So the focus is going to be to build products to address the size of business. That is going to be and not that we are not making any bottom line. That is not the kind of business we're looking at.
No, I appreciate that. So from the working capital standpoint, my question was simply that, while in your guidance...
I'll give you on that. See, we also get advance against every contract. And in a MOD contract, typically what happens is, it is not a contract which is one-off shipment. There is going to be, during the course of a few years, there were multiple orders. The shipments happen over various stages of the overall cycle of production on the overall product life cycle or the program cycle. So there is cash flow coming in together, and we have an advance also ahead. So we should be able to manage the working capital with non-fund limits, non-guarantee limits. We should be able to do that. I don't think we'll be very hard pressed for working capital going ahead. We're not generating a lot of cash ourselves. I don't think we're particularly worried about money. Of course, we need to do the conversion cycle, reduce net working capital, we have to go and bring it down. And this is mostly happening not in MOD contracts or production contracts. It happens more towards development contracts, acceptance, and so many other things happen. So as long as the production contracts become larger in the size of, in the overall percentage which we have, the working capital will come down. So we expect it to come down going ahead, not go up as a percentage of the contract.
Optimally, how much should it come down by? I mean, what could be a stable, sustainable working capital in base sales for...
Venkat just said the next 2 years will come to expect over 280 days. And going ahead, we probably, the nature of contract and business, we try to bring it down consciously.
Okay. And sir, on this BrahMos seeker, what's the status of development? Because the order pipeline for BrahMos as a company is fairly large, more than 30,000 crores. And between you and I think Electronic Corporation of India, the seekers have to be supplied. Is the qualification for that already done from your side?
They're yet to fly it as a missile. That is getting postponed for various reasons. So as and when they complete the trials, we should get the contracts. So today we are not projecting the contract in internal. Okay, it will happen during the process this year.
So is this for the BrahMos NG or is this for the current version of BrahMos?
BrahMos NG is still not a product which has been launched. Only for the current ones.
Okay. And what could be the possible timeline for, getting the approval? Any idea?
I'm not able to comment. You would ask BrahMos that. So rather than party comment on that, they have to do the field trials and then come back to us. But they are showing urgency and maybe 3-4 months because next month it starts raining, they won't do the trials. So maybe after the rain comes down, immediately the trials will happen. And in the meantime, we're talking about some orders for pre-production. So this all has to happen. Hopefully, over the course of this year, this should convert. Is what we're hoping, but we can't say for sure.
Right. And HAL now has clearly indicated that LCA Mark 1A, 16 per year sort of assembly and delivery is already scheduled, and with the Nashik facility coming on stream towards the second half of this financial year, probably 24 a year. So from that perspective, what you perhaps get some visibility. Over and above that, they also indicate that for the next 3 years, they have a pipeline of almost 160,000 crores between helicopters and aircrafts. I'm presuming that from an avionics standpoint, you are very much there to participate in both the platforms, fixed wing and rotary. Could you give some idea? I mean, does this visibility coming from HAL, give you some sort of a line of sight for the next 3-4 years on work related to that?
It's a bit too early for us to comment on it. These are internal programs and projections of HAL. Unless we get indicative RFQs from them on timelines on delivery and whatever we are developing in some of the aircraft which you're talking about, I won't be able to comment. We've taken a very small percentage, very small contract value compared to the numbers you're talking about for this year, where we reported. So the contract, once it comes, we'll deliver probably this year, depending on the schedule. The rest of the things, the inquiries have not come. So as and when it happens, we'll be able to take it. We're not projecting it in this year's order intake.
No, I get that point. My question is that, from if HAL gives the visibility of, 5-7 years.
They've not given us any visibility for us to comment on it.
Even they're talking on their investor call, so I'm presuming that there is a good by them. So I'm just trying to understand and assess what could your opportunity size be from that.
So we can't comment on it because we don't have any visibility there. So we don't want to comment and then get into another call which says why this and it happened. So better I'm only commenting on what I have knowledge base about. And what may happen tomorrow, we'll be very glad to obviously participate. We're looking forward to such requirements. And at the present moment, we can't comment because trials are on in some of the aircrafts. And after trial completion and acceptance, and then how Air Force and HAL do this, then only contracts can be happening. So it's a bit premature for me to comment on those things.
Okay. Thanks. I'll get back in. Thank you.
Thank you.
Thank you. Next question comes from the line of Abhishek Poddar with HDFC Mutual Funds. Please go ahead.
Hi, sir. Thanks for taking my question. So regarding the margins, one question on this. We have about 40% from development contracts and 50% plus from production. Would the margin be very different in these contracts? And also, as your production contracts would increase as the volume, revenues increase over the next 2, 3, 4 years, would we see a mix, on the margins because of that happening? And the reason I'm asking this question is because, when your peers are there, their margins are much lower when their production is a major part of their revenue mix.
Okay, so this question is answered many times. See, what happens is margins are not depending on the development or production contracts, especially when it comes with DRDO-driven programs. They remain static irrespective of what it is. What really makes the difference in margins is what is the competitive scenario and at what cost we got the product. Is it L1 business, etc. Some portion of the L1 business, obviously the margins become lower because we integrate some of them to make the systems. So the other contracts which are developed everything in-house, our margin becomes higher. It depends on how much we contribute towards the product on the final delivery. So that is how the margins vary. It's nothing to do with development of production. And that's one head. That's not also true when you look at another perspective. Suppose MOD business comes and we are competing with so many people. We need to compete and get contracts. So obviously sometimes margin will suffer. But again, quoting 50 crore contract, 20 crore contract, 150 crore contract in DRDO, the contract size is 1,500 crore, 2,000, 3,000 crore, 1,000 crore kind of contracts in MOD. And so obviously we may not be able to keep the same kind of margin percentage because a lot of bottom comes and integration happens. The margin comes down there. But overall revenue will substantially go up, kick up multiple times higher. So this is the business to be in. In those businesses, what we plan to do is wherever electronics is coming into picture, if we can develop the electronics in-house with our own IP, rather than relying on foreign IP and foreign products and do manufacturing alone for them, our margins then become necessarily higher. And once the margin is necessarily higher, it also gives us the leverage. You see, when you quote competitively reducing margins, can I quote the L1 business? So this will be a leverage for me to win more contracts and also support the products for the next 20 years of life cycle support. With local support, not going to costly support from foreign OEMs. This is the name of the game as I see it. If people work out differently, a lot of companies who don't have a local IP depend on foreign contract OEMs to provide the IP, so they become costlier. Then but still they win the order because their margins can be very, very low as win order. So this is a game which has been played. Today India doesn't develop full systems. We are one of the few companies who are trying to say, why don't we develop the few systems here in India rather than having collaborations? So this is how it goes. Our future, what we're looking at is develop products ahead of time, build the product in-house, see that when the new inquiry comes in NECO, or buy and sell, whatever opportunities come to MOD, then we position our products with IP and product tested here to give a better winnability and scale the business substantively. That is the game which you're trying to play.
Understood, sir. So, sir, regarding the order book that we have and the pipeline of 2,000 crore that you mentioned, should we assume that the system integration contract and what can be margin dilutive, those are very limited in those?
For a contract on hand, there is two contracts where there is a lot of system integration or bought out where they're building, land and building, all of this coming into picture. One or two contracts, the margins are lower. But the rest of the contracts are our exact development on IP developed by us, so it remains the same as what we've been doing all along. Going ahead in the next 1,000 crores, we talked about these are not contracts which is going in for multiple vendors and mix of contracts and integration is not there. So there the margins are likely to remain what we've been doing in the last so many years.
Understood, sir. And just one more question on the BrahMos seeker. Sir, ECN's product was tested in 2018. And now it is yet to be tested. This confidence that we have that we should be getting the order is based upon the product quality, or what assessment is that, sir? If you can give some more color on this.
Our product quality is very good. It is just that they have not taken it for flight trials for a long time for various reasons. The moment they take the flight trials and surpass the flight trials, part of the trials, we should get an order. This is what they've been telling us. But I have no control over when they will test it. So we are also impatient waiting in the queue when the trials will get conducted.
So we have
one difference is our seeker, whatever you say, like I've always told you, is that we designed everything in-house. The gimbal is designed by us, the motor control is designed by us, the mechanical subsystem is designed by us, the transformer is designed by us, the signal path is designed by us, the up-down power is designed by us. Everything is designed in-house. We don't buy. So obviously the quality is in our control.
Understood, sir. Thank you, sir. All the best.
Thank you.
Thank you. Next question comes from the line of Renu Baid with IIFL Securities. Please go ahead.
Yeah, hi. Good morning, sir. Two quick questions from my side. First, just want to pick a bit of your inputs in terms of, again, in terms of guidance. Sorry for this. You mentioned about 25% revenue guidance and 30% margin, profit guidance despite dip in operating margins. So is it that you're expecting a sharp jump below EBITDA when it comes either in terms of other income or sharp shrinkage in the finance cost? Any big change in the tax rate that we're expecting? Just trying to understand the math behind this.
Okay. There's no very elaborate maths. We kept the guidance conservative in terms of revenue. That's all there is I can say because it's depending on the mix of deliveries we do. We don't expect a substantial increase in other income because it remains whatever it is. Maybe the marginal increase may be there. We don't know. It depends on the cash flow during the course of the year. Within our budgets, we think it will be remaining around similar or slightly more is what we expect. And operating costs also, we have done the budget and very clear their goals, so we have an idea of what the costs are. The idea is to keep the revenue grow, the bottom line growth. So we will try to deliver some products to see that the bottom line growth continues to happen. So that is all there is. Maybe top line may also go up. But we didn't want to give guidance on that because numbers are getting multiplied by market. So we don't want to give a multiplication and fall flat later.
Sure. Secondly, if you look at the backlog, closing backlog, especially for production orders, now we are nearly back to 500 crores kind of order book with with nearly 480 crores kind of inflows this year. So of these 490 crores of order backlog for production orders, what proportion should be executable in fiscal 25? The fact that you mentioned that Arudra would be over 2.5, 3 years based on BEL's execution schedule.
Yeah, I think a large portion will get executed the coming year on production contracts. I don't want to give it a percentage, but it will be about 60-70% will get executed this year. And some of the development contracts will get executed this year is what we're thinking. We're also putting a small portion of the new orders coming in this year to be executed this year. And that is our budget internally in May.
Sure. And in terms of investment in CapEx, how are we looking at spend for fiscal 25-26 in terms of expanding capacity capabilities for new projects?
Over the next 2 years, we're planning to spend some 100 plus crores on CapEx. And so it all depends on when we start the CapEx, purchase order and how long the buildings and other things, equipment come in. So whether everything will get spent this year or we won't go to next year, it's something we have to, the committees are working on the proposal for the board to clear. But over the next few years' time, we should be able to spend that because we need the infrastructure for the future growth to put in. So we bought the land already for this, so construction will start and some contracts will be placed over the next 3-4 months to see that infrastructure is getting created. This is one part of the CapEx we do. The other is our development. We continue to develop products. There also will be a larger part of the spend will happen this year over last year.
Got it. And lastly, within the 2,000 crores order pipeline that you have highlighted, are there any notable large projects or orders which you would want to highlight and that which could be helpful for us to track in terms of progress, in terms of investments and awarding?
No, this is a bit too early for us to say. Let that happen, let it all come up to the open and then we will comment.
Sure. Any input in terms of where are these large projects like Ashwini, LLTR, etc., which where we were betting a reasonably large part of the pie? Where are they in terms of pipeline? Is it a part of the pipeline or still not in the foreseeable future the way the end markets have behaved?
It is part of the pipeline only. It is not part of the 1,000 crores I'm talking about revenue or order intake this year. The inquiries that come, we will all be sorting, and we do not know who will get the order and what percent we will get. So we will wait and watch the next few months, see what happens there.
Got it. Sure, sir, that's helpful. Thank you and all the best. Thank you.
Thank you. Next question comes from the line of CA Garvit Goyal with MS Analysis Advisors LLP. Please go ahead.
Hello, am I audible, sir?
Yeah.
Good morning, sir. Congrats for a good set of numbers. Just two questions. One is on the industry perspective. So are you people witnessing any kind of potential risks on the supply chain or demand side that could lead to a slowdown in near to medium term? Additionally, is there any emerging competition that might be capturing the market share, thereby impacting our order flows?
We don't see any supply chain risks presently. We have no problem in getting material. So we don't see that. So that's not the problem. The second thing is, you're saying there is a risk from
emerging competition or any demand slowdown.
So competition has always been there, but I'm not seeing any particular risk which has to be considered. Obviously, obvious risks are always there because the products that are trying to develop is already available abroad. So people do tie up and bring the products here. So that risk has always been there and continues to be there. The other risk is our revenue, what are the contracts we get with DRDO, competition. This is always there. These risks continue to be there. The idea is what we're trying to do is try and be, we build ahead of time to see that we meet requirement early and do an early mover kind of an advantage we have. Since we are developing in-house everything, we're trying to invest ahead of time and build the product to address the competitiveness which you're talking about.
And any demand slowdown expected or in the near to medium term?
No, demand is fairly high. We are looking at a number of opportunities going ahead. Number of opportunities. It all depends on how we build products and whether we are competitive and the opportunity arises. So this is how, and the other thing is build bandwidth internally to the office to see that we address the opportunities. So we have seen those issues and we're addressing them essentially.
And sir, regarding the utilization of QIP funds, so could you provide an update on the current status, specifically like how much of the QIP funds have been spent so far, and when can we expect the launch of any significant new products financed by these funds?
On the development, as recorded in the balance sheet also, we see over 40 crores has been spent over the last year. But largely out of all the 40 crores, and 30 crores of the materials which are procured for the products. And the people cost is about 7 to 8 crores or something people cost. And overhead costs will be there on the development. We will continue to spend a large portion of the development funds this year. And the products, at least physical products will start coming out in the next 6 to 10 months. Will start coming out. And then we have to go through trials, flight trials, ground trials, whatever trials are necessary. And part of the trials, we are not able to clearly determine the timeline for trials because it's a multi-agency system. The government has to get involved in all the trials. So we are trying to see how best to address that and how quickly we should be able to do it. And that is going to be a work in process. But our end development we will finish. But further, the product, we have to spend money on actual trials. And then only the contracts can happen. So, but we are confident the products will meet the requirement. And it's world-class, today's generation products we're designing. So it's second to none world-class products we're designing. So hopefully customers like it and allow us to do the trials and take it further.
Fine, sir. And so you mentioned 40 CR is spent already out of, I think, 500 CR we have raised. So what is the expected timeline for fuller utilization of these funds?
The 500 CR comes in various things, working capital. We're given a lot of classifications. The development funds at QIP time is 160 crores. The development funds which were taken. Of course, the rest of the money also is available for development because it's all available as cash in our office today. So we're a bit, we keep the money now, looking at opportunity and spending it. As the market turns, what are the areas where the market requirements are large and which can address? So we're trying to deploy that money to address the market requirements without actually spending all the money and then see the markets are moving slowly. So we're taking a cautious outlook how to do this. Wherever we think there's immediate opportunities and there is unaddressed by anybody in the market, we're trying to invest money there and see that the unaddressed market is addressed by us. So this becomes easier and also the world-class product for them. So we are doing that effort in-house. And I think it's a next 2-3 year kind of a program. And the idea is to be able to get some orders for the products against development we do today. We want to keep the development money in rotation so we can continue to do further investment going ahead to scale the company to 8,000 crore turnover. This is what our intent is. So let us see how it goes. But we have the money now, so we are quite carefully spending it.
Hello.
Hello?
Am I audible?
Yeah.
The last question is on de-risking from the defense sector. Like last time you mentioned about some negotiations happening on other industries other than the defense. So how do you look at it? How do you see the other industries' contribution to our top line, say, in next 3 to 5 years down the line?
No, I didn't understand the question. What is that? I didn't understand the question. Can you repeat, please?
We have lost a line. A reminder to all the participants that you may press star and 1 to ask a question. Next question comes on the line of Jatin Jadhav with Shastra Capital. Please go ahead.
Hello. Good morning. Am I audible?
Yeah.
Hi. So, sir, basically my question was pretty much answered, but I just want some clarity from you. This question is regarding your competition. So, based on your competition, your EBITDA margins are around 40 and others are slightly on the lower end. So I wanted to understand, since you are saying that you will maintain these margins, is it because of the IP we have developed in-house and the products we are making in-house and integrating them as well? That's why we have a higher margin compared to other competition?
There are two reasons for it. One, we started developing a product ahead of competition many years back. So we have built, see with DRDO, we do parts of the product. Over a period of time, we have started building a lot of the product DRDO. And it's really designed house. There is other people may develop a small part of the product. So when the market knocked out, we are probably getting repeat business from whatever we did 7, 8 years back. And that has started coming in or kicking in. So that automatically, and second, we never developed the development costs, we never recovered from all these products. So we invested in the last 15, 18 years, we've been investing on product development and competing with foreign OEMs and selling those products in India, absorbing the costs. So we think we implemented development with our own money and we written off all the development costs as part of revenue expenses. We never capitalized it all through our life of data patterns. So maybe those are all kicking in now and we get repeat orders and numbers are coming. And our cost model is different because we don't, these are supposed to buy and integrate with others. Since we are not buying anything, maybe bottom line is better. We don't know. Maybe that could be a reason. The second reason is probably some of the requirements are urgent and some customers feel that we are in a position to deliver against the urgency and meet the requirement. So we get a lot of single vendor orders. So other people have to design and develop. We probably have a design in-house. So maybe we get a lot more single vendor orders in other companies. And here again, since we've done a building block kind of a development all through our life, we tend to use the building blocks rather than redesign from scratch. And those are tested. So the timelines to deliver are far faster. So this could be a second reason. I can't exactly comment on other people's business, and it's not right in the part to do that because I don't know the strategies what they employ. But what we are doing is what we think is right for our business.
Makes sense, sir. One more follow-up question regarding this is, as we eventually will, currently also we are into system integration. We supply a complete system. So as and whenever we complete system, we command a higher margin?
No, again, that can't be said. There's no zero answer to this question. It depends on what the complete system is. If it is going to be a lot more vehicles, you understand, no? I really don't know.
Yes.
See, what we are trying to do is maximize Indian content or in-house content in a contract. If we do this, I have a better P-win in a competitive situation. This is all I'm saying. So we're trying to put our money and build this, and so we can scale the business. See, India doesn't have products. We rely on DRDO today for building products. We are the only design agency in India. So rest of us the private sector are doing collaboration with foreign OEMs to build the product here and then do a work share. So only do a work share. Obviously, you have to share our own margins also, right? So what we are trying to do is the opportunities are now very big opportunities. If we can address our portion of the opportunities in Indian systems designed in-house, I have better P-win and hopefully we'll have a better bottom line. This is cannot, one need not know with the other, but the scale has to happen. The scale happening, we'll all grow because the requirements are so large.
All right, sir. And one,
we are growth. We're not looking at a quarter-to-quarter guide. Sorry.
Hello. Am I audible, sir?
Yeah.
Yeah. Sorry, one follow-up question regarding the market size per se. Regarding just the radar systems which you are providing, how big of a market do you see growing or growing up to in the next 4-5 years or 3 to 4 years, wherever as far as you have visibility?
I think market size is very large, but it's not addressed by us everywhere because, you know, when you make close-in weapon systems, for example, LRD, you know, LNT gets an order. The radar gets imported, something comes part of the weapon. So the big systems, you know, when an integrated system comes, radar becomes a portion of the integrated system. And it's not accessible to us because we don't do the weapon. So, you know, what really happens when all this when India starts collaborating in-house in India, an ecosystem start developing when we combine our strengths together and address the opportunities, then we can say the market is bigger for us. So not all opportunities on radar are addressable directly by us. It still comes from abroad, or either in technology transfer or joint production or something of the sort. What I am seeing on addressable by us in the next 4, 5, 6 years is the upwards of 20,000 crores. So which we can address. So we are working towards that. That is the first thing we are doing, building our own products. Second, we are also doing the product development, which is not even addressed by us, get the products out. Then maybe we can collaborate with the OEMs in India to see why are we importing this when India can offer a solution. Look at an ecosystem we built here. So it's a very long-term play strategy. It depends. We are starting from scratch in India now. So the field is very open. It depends. We can be competitive. These world-class products meet customer requirements within timelines. And we have something going, and we need to collaborate with people in India also. So we look at all opportunities. How is the long-term game? And that is why we need the bottom line to scale the business because we need money to scale. We're going to put a lot of money in development. We're looking at a 3-5 year kind of horizon for whatever we're trying to do. We're not looking at year-on-year horizon at all.
Got it, sir. That's pretty much it from my side. Thank you so much for your valuable insight and all the best for the coming year.
Thank you. A reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Manish Kumar, an individual investor. Please go ahead.
Yeah. Am I audible, sir?
Yeah.
So most of the questions have already been answered, so I'll just skip them. I have one last residual question, and this is in terms of the human resource, the employee cost, which is what I'm looking at on a quarterly basis, and I'm looking at the employee cost data as a percentage of the expense that you have. So what I saw is there's a very significant.
I'm not able to hear you clearly.
Is it clear now? Is it clear now?
Yeah. Talk a bit slowly so that I can put the pieces together.
Sure. All right. So my question is in terms of the employee cost as a percentage of the expense that you have quarter on quarter. That is the context. So what I saw is that there's a very peculiar pattern, right? This is always, the percentage number, which is employee cost as a percentage expense, is always the highest in quarter 1, and it gradually reduces through quarter 2, 3, and 4. And this has been a constant phenomenon during the last 3 years. So I just could not put my head around as to why this is so cyclical, the employee cost. This is happening for almost last 3 years, every quarter 1 to quarter 4. So if you could give some insight.
You are commenting on employee cost as a percentage of revenue?
Expense, percentage of expense.
See, what happens is, ours, traditionally, government business is a year-end business. If you looked at the 2017-18 balance P&L, you would have seen that almost 80% goes to last quarter. And first 3 quarters we used to make cash loss. It's very difficult to manage it to see that our quarterly revenue is also managed properly. And we went public once we knew that there will be some reasonableness in our quarterly work. and then on-hand contracts are there, which we can deliver on a quarter-on-quarter basis. So the employee costs, though, are not varying so much on a quarter-to-quarter. On a percentage of revenue, it will be higher in the first quarter, going down the second, and accordingly last quarter. So last quarter tends to be the largest revenue quarter for us. This also last year we managed to contain it, to bring down the last quarter to only 35-40%, as against 50%, 55% in the previous year. So that is the ratio you're seeing. And another, maybe we have increments also, coming in April, so maybe that pushes up. We recruit through the year. We're recruiting number of fresh engineers and even lateral recruits through the year. We have our size of number of employees is going up substantially, about 20% year on year, because we are building competency for tomorrow. And all the people we are building and training, so they can do large systems tomorrow at various levels. So we're continuously recruiting. So that also could be, I don't know exactly what the numbers are, but I think this is what is happening.
Right. So my concern was that I was thinking that, I know I might be totally wrong, that maybe we are hiring only for specific projects, and when the projects are getting over, maybe we are having people leave the organization. In that case, my concern was that how we are retaining the knowledge and the expertise that we have built over the years. In one of the slides, I saw that some of the core team members have stuck in the organization for almost 2 decades. Right? So I was trying to relate if this in the employee cost in the later quarters is because of any churn which is happening. Looks like the answer is no. Can you please confirm that?
We're managing our employees daily well. Of course, there is people leave because they get very well trained in data patterns, so they don't join multinationals. We are aware of that because the training levels here is very, very, very high. We're unable to get lateral recruits, so we recruit from college directly. Our CTO was started from college 35 years back. Most of the people who are 20 years plus are all straight employees from companies and directly from college. So we take a lot of people from direct college and train them at all walks of life for testing, development, software, hardware, mechanical, everything. So, but that is not the reason. We're not losing very many people compared to maybe multinationals and other IT. I think our attrition ratio is far lower. And also we have 100 people as shareholders in the company.
Thanks a lot. Thanks.
Thank you. Next question comes from the line of Vishal, an individual investor. Please go ahead.
Am I audible?
Yeah.
Sir, first I would like to place my congratulations to you for such a good set of numbers, and the value addition, the value creation you have been doing to shareholders. Thank you very much for that. And my question was, if I look 5 years ago, our data pattern figures, so can we assume, because at that time, if I compare that time to current times, what we have achieved today is, the problem at that time is the profits out of current times. So can we, are we looking forward to repeat the same feat in maybe next 5 years or earlier than that, or even earlier also?
Vishal, that is our intent.
Great.
Let's just go and do it.
And sir, can you throw some light on, what could be our general execution rate and percentage as a percentage of the order backlog?
I will not comment on that because it depends on, it's not only left to me to execute the contract. It also, the timelines, the customer wants the execution done. Okay. More often than not, we find that in the production contract, we can execute in 1 or 2 years everything. When you will give me 1,500 crore contract, I'll execute it. As long as already development is carried out, all I have to do is set up a line and I can execute it. So we have all the competency. We have a pick and test machine, we have automated test equipment, we build our own automated test equipment for production line systems. We do everything in-house. Since the process definition is our line is defined by us. Electronic component manufacturing, EMS line, we have 2 lines in the office already. we have tests in the office. So everything we have in-house. So we can execute. But what happens is, customers don't want everything scheduled overnight. Give me a quarterly turnover, so then we have to stick to it. Second area where the concern is where, when large development happens, then the development cycle takes the time. You can't execute a development program in 3 months and 6 months. Because not only do we design and produce, there are certification agencies get involved for product safety and product certification. It takes time. Documentation and process. So that really limits us, not on just the capacity what we have in terms of delivery. We have finite capacity of development, but on production we can increase capacity very fast.
So you say we cannot lay any specific percentage, on the completion percentage as a percentage.
We have. For example, we say 1,000 crores, what we can do, 2,000 crores, how can we deliver? But we are matching. That is what we are doing is we are trying to enhance our capacity in terms of infrastructure. We are creating additional infrastructure because we think we need to scale 3 years from now. Our order will happen 2 years from now where they go for external testing and they have a delay in delivery. So we're creating the test standards and equipment in our office. We get large contracts for integration and may not have factory space. So we're enhancing factory space to see that in anticipation of contracts happening 2 years from now, we're starting investing ahead. We are also expecting growth, substantial scaling happening in the next 3 to 5 years. So our competency building, manpower building, management bandwidths, everything on a top to bottom level, we are scaling our competencies and bandwidths. A very, very active HR team, which is looking at all skill development from bottom to top and mandatory training programs to do this. So a whole lot of things are happening to see that we are not caught wrong-footed when we scale. And we accept the scale because the market size is so big. So we are very bullish on the market and our competence to deliver on the market. So we are actually investing ahead of time, not only in product development, but also for delivery and manpower.
Okay, sir. Thank you very much. And sir, I also place best of luck and you keep achieving such great value additions for yourself, for the team, and for the shareholders. Thank you very much, sir.
Thank you. Great for us, Vishal. Thank you.
Thank you. A reminder to all the participants, please restrict yourself to one question. The next question comes from the line of Devansh Agarwal, an individual investor. Please go ahead.
Hi, sir. So can you hear me?
Yeah.
Hello?
Yes, I can hear you.
Okay. So, one very specific question with respect to Arudra radars. In some press publication, it was mentioned that Bell got the order of 2,800 crores for Arudra radars. However, in our presentation, it shows around 180 crores of order for Arudra or something. Is it not possible to directly take the order from MOD, or why is there a difference between the quantum? Is what I'm trying to understand.
See, these are all the traditional way. DRDO has their own investment money, and they develop radars required by Air Force later. And they finished the development about 7-8 years back, and they demonstrated to MOD and Air Force, and it was approved. Then the transfer technology went to Bharat Electronics as a nominated partner. The process in India all along is that once development gets done, it is transferred to production agencies, which is BEL, BDL, HAL, etc. And as and when the services want the contract or more products, they then get the revenue approval from MOD. And once the approved things come in, they place a single vendor order on the PSUs. And during the development, if people like us have done the product development for parts and subsystems, the transfer technology agreement which BEL signs includes our name. So the idea is to see that has been qualified. So they back-to-back place the order on us. So whatever we have designed for their part. So that is the way the whole business is done. Today, it continues to happen like this where DRDO has developed products. But in MOD tenders, this is open to all of us. We are free to do whatever we want. We build the full systems. So this comes in various kinds of categories, from Make 1, Make 2, and other categories of MOD tenders. We are also participating in those categories of tenders. Where we can build our own system, our own radars. Not only us, a lot of companies in India have started saying, let us do this and look at the opportunity ourselves, either by themselves or in collaboration with foreign vendors. This is happening. So as more and more of this starts happening, then we'll start building the full system ourselves. So this is the way it's going today.
Got it. Got it. And the second question, sir, sorry, nothing. We saw on your presentation that there's an increased focus on the offset. Is there any action going on? The reason I'm coming from is recently Azad is doing announced some kind of offset with Rolls-Royce, and it saw great momentum in the market at least.
So we've never, I don't think there in the presentation we talked offsets. We are not in the offset game. We build our own IP. We have not done any manufacturing for any foreign OEMs today, and we are not really an offset partner for. We do have partnerships with various companies, but that is on product development rather than offset. The offset is a low value, low margin proposition normally to do manufacturing alone in India. We didn't want to get into this long back, though we had a capability to do it, because our focus and IP development is growing. So we intend to build products rather than focus on our offsets. So we're not really recipients of very large offsets.
Got it. And all the best, sir. For a retail minister like us, it's always a good moment to see the stock price running. Thank you, sir.
Thank you very much.
Thank you. Next question comes from the line of Arnab Bhattacharjee, an individual investor. Please go ahead.
Hello, sir. Good morning. Just wanted to know about the liabilities we are able to achieve in this year. Given the fact that the way I see. Hello. Hello. Am I audible?
Mr. Bhattacharjee, can you hear me? Please go ahead with the question.
Yeah, I'm able to hear you. Sir, I believe that like, when it comes to radars, it's a very complex process, and it requires a lot of technical knowledge. So just want to understand like how our R&D team is like. If you can share any such a story that we had in the recent past, and how do we plan on upskilling further in the developing goals that we receive? How like do we have collaborations with foreign universities or foreign businesses?
We started building radar components and parts with the DRDO over the last 20 years or 18 years. Then we started building upgrade programs to get the competency of IP and software and domain, other than just electronics. We started, contributing towards upgrades of radars for ISRO for the tracking radars. We delivered about six tracking radars upgrades for them. Our operation more than 10-15 years with Sriharikota and in Trivandrum. So this is where we started learning. Then we started building our own, surveillance radar, again open tender with ISRO. That ISRO allows us to build a full radar. So we started learning outside and doing very modern systems with DRDO on the subsystem levels. But the domain, etc., we started doing outside. So we started actually quoting non-defense radars where we learned our competencies, and those are installed and working for 7-8 years now. So an opportunity came with MOD tenders for a precision approach radar. We decided, why don't we develop the radar from scratch? And we were lucky that we could demonstrate the radar in 18 months from scratch and won the contract for about 380 crores, 250 crores to be delivered in 2.5 years, which we delivered last quarter, we delivered the full system. So hopefully we expect some more orders if at all it happens with customer requests. Hopefully we should get more. So this has been a long journey in putting products. We have a domain team. We continuously engage in development of radars. We now participate in make-to programs in the MOD. We have a couple of export contracts for radars, which we're developing for one European country as well as a South Asian country. We've got some few radars orders, which we're developing and probably execute this. This is our IP and our radar. So we are investing continuously in radar development and IP development. Not only radars, but also in electronic warfare. We are fortunate to work with DRDO for many years now and learn with them and build products for them, and in the process learn domain and competencies and capabilities so that we can address the future requirements in India on EW program, which is also exportable. So it has been a continuous journey. It's not an overnight thing, and we don't have foreign collaboration. It's all India, DRDO, what we've done, ISRO, and other areas where we've studied books, go implement, study, fail, correct, learn. It's been a process.
Thank you, sir. We should be very good.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for attending this conference, and thank you for all the very interesting questions about our company. We are interested in building, scaling the organization as we go along. It's been a long journey for Data Patterns. It's not a startup, though we behave like a startup within the organization. We built up scale competencies over many areas, process, infrastructure, all of them done. The markets have opened up largely, so we are developing products for addressing the markets, increase our total addressable market. We are in line with whatever we are doing. Our products are under development. We expect that we'll scale the next 3 to 5 years. We need to substantially scale the organization. We're building an infrastructure to meet that expectation. And the government is very motivated to do more in India, and that is the right the right thing for us, because we've always been saying Made in India with pride. So we hope to do a lot more to scale the business. If you have any further questions, kindly address the questions to Go India. We'll be very glad to answer those questions. Thank you very much. Thank you for the call. Thanks.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us. You may now disconnect your lines.